Welcome back to Noob Selling Options. I am absolutely thrilled to have you here today because we are tracking a massive, frankly game-changing macroeconomic shift happening right now in May 2026. If you've been watching the markets lately, you know things are starting to feel, well, a little turbulent. Today's explainer is going to break down exactly why that is, and way more importantly, where the smart money is heading next. We're looking at a classic shift in the AI supercycle
So let's dive right in. Here's our roadmap for today. First, the AI CapEx warning. Second, Micron, the bull versus bear case. Third, SanDisk, bull versus bear. Fourth, the SaaS gold rush. And finally, number 5, crypto equities.
Part 1. The AI CapEx warning, a classic distribution phase. Look, we have to start with the elephant in the room. When incredibly well-known investors like Khoo start releasing warnings about market crashes and overextended valuations, and Chicken Genius starts sounding the exact same alarm on those big tech darlings, it's a massive red flag. We need to pay attention. What they're pointing out is a textbook blow-off top dynamic. You know, that terrifying moment when an asset's price just skyrockets on pure hype, right before a steep plunge. This is that classic stage where the smart, institutional money is quietly handing off their bags to retail investors who are just rushing in, totally blinded by late-stage FOMO. And honestly, it perfectly sets the stage for a brutal sector rotation. So what does the anatomy of a rotation like that actually look like in practice? Well, when the AI infrastructure narrative is finally fully priced in, all that capital doesn't just evaporate into thin air, it moves. We typically see a really violent exit out of high-beta semiconductors and memory plays, you know, your MUs and your SNDKs. That capital then often flows right back into lagging defensive sectors like healthcare, financials, or industrials, the guys that basically sat out the massive tech run-up. Meanwhile, for the mega caps, think NVIDIA, Microsoft, AMD, and Broadcom, the entire strategy shifts from aggressive capital appreciation to straight-up capital protection. No one is questioning their structural strength, but their near-term valuations? Yeah, those are absolutely in the hot seat. Part 2. Micron Technology, bull versus bear.
Let's zoom right into the memory market, which is the absolute engine room of this entire AI boom. And right now, no one is more in the crosshairs than Micron. The bull case for Micron is actually anchored by a really massive structural shift. They are aggressively gobbling up market share with their HBM3E technology, which, if you don't know, is the absolute fastest, highest capacity memory for high-end AI GPUs out there. Plus, they're actively taming that historically brutal boom and bust cycle by locking the big hyperscalers into 3 to 5 year contracts that basically builds a super safe floor under their earnings. And hey, compared to the rest of the AI space, their 12 to 25x forward PE is incredibly grounded. But the bear case tells a much darker story. History always tells us that during tight supply, customers panic and they overorder. If AI data center capex is actually peaking right now, we could be staring down a massive supply glut that just hammers Micron's pricing power. There's also the constant looming risk of disruptive new architectural tech that simply reduces the need for cache memory altogether.
Part 3. SanDisk, bull versus bear. Now, let's shift gears over to SanDisk, who are flying solo again after that highly anticipated spinoff from Western Digital. Just pause for a second and absorb this number. 251%. That is absolutely jaw-dropping year-over-year revenue growth. They are practically strapped to a rocket ship right now, and this whole trajectory is being driven entirely by hyperscalers who are just desperate for massive enterprise SSDs to store all their giant AI training models. But here's the catch. That explosive momentum directly clashes with some really heavy underlying risks. The bull case, for sure, is thrilling. Beyond that 251% growth, SanDisk is sampling a brand new high-bandwidth flash, or HBF, architecture later this year, and they've got a massive cost efficiency edge thanks to their joint venture with Kioxia. But man, the bear case is heavy. SNDK is quite literally priced for perfection right now, trading at a 38 to 43x forward PE. They've benefited immensely from short squeeze dynamics, which means if macro momentum stalls even a little bit, the downside correction could be incredibly violent. On top of that, the NAND flash market is notoriously cutthroat and volatile, and that promising new HBF tech, it probably won't even be fully commercialized until late 2027, leaving them super exposed to brutal pricing wars in the meantime. So the bottom line here is pretty clear-cut. MU stands out as the much safer core holding. It's fundamentally grounded, it has lower valuation risk, and it boasts a real structural safety net thanks to those long-term contracts.
SNDK, on the flip side, is your high-momentum, high-beta play. It's going to give you much juicier action, sure, but it carries a dramatically higher risk of a sharp, violent downside correction if that NAND cycle turns sour.
So I want you to really think about this for a second. If Adam Khoo and Chicken Genius are right, and the infrastructure build-out phase, the hardware, the chips, the memory, is actually facing a blow-off top, all those billions of dollars have to find a new home. So where does the smart money rotate to next? Think about it like this. It's the perfect metaphor for this capital migration. We are officially transitioning from the picks and shovels phase to the gold miners phase. We've literally spent the last few years totally obsessing over the companies building the AI infrastructure, the hardware and memory plays. But now, the market is aggressively hunting for the companies that are actually using that infrastructure to generate massive amounts of real, sustainable cash. Part 4. The SaaS Gold Rush. From narrative to monetization. And here is exactly why the money is rotating heavily into software. Recently, we saw a really severe valuation reset in the SaaS space. The market basically threw a tantrum and heavily punished major software players because a few enterprise deals were delayed, which drove valuations way down. But here is the massive catalyst. While the market was panicking, the underlying fundamentals actually got stronger. Enterprise clients are finally moving past those cute, simple AI experiments, and they're deploying full-scale agentic AI workflows. That means AI software that can actually make decisions and complete tasks entirely on its own. Because SaaS valuations have compressed so much recently, while hardware is still priced for absolute perfection, the smart money sees an incredible risk-to-reward setup here. They're moving capital into SaaS to capture that high-margin, incredibly sticky, recurring revenue that hardware just cannot offer during a cyclical downturn. To put the sheer scale of this monetization into perspective, just listen to this number. $1.5 billion. Companies that control the enterprise software space, like ServiceNow, for example, are quietly scaling their AI-specific revenues right up toward that $1.5 billion mark. The cash flow isn't just a promise anymore. It is becoming very, very real. Part 5. Crypto equities, the institutional phase. Now, if SaaS is the smart, steady rotation, crypto equities are your high-beta, high-octane alternative. And it all starts with Bitcoin comfortably holding its ground above the $80,000 level. With that strong baseline, the dynamics of the post-halving cycle are in full swing, acting as a massive, flashing green light for institutional capital. Why is the big money rotating here? Because institutions desperately want exposure, but they still prefer the regulatory safety of traditional equities over buying direct spot crypto. So what do? They funnel massive liquidity into proxies like MicroStrategy, exchanges like Coinbase, and top-tier miners like Mara. At the exact same time, the network effects are just exploding. Stablecoins like USDC are heavily integrating into traditional financial rails, and as networks like Ethereum and Solana scale up to actually handle real-world assets, or RWAs, and institutional settlements, the publicly traded companies tied to this entire ecosystem are transforming into massive, high-margin cash flow generators.
So, I want to leave you with this final critical question. As the market peaks on infrastructure and shifts its heavy weight toward actual monetization, is your portfolio positioned for the gold miners phase of this AI supercycle? Are you ready for the great rotation into SaaS and crypto? Take a serious look at your exposure to hardware versus software and review those risk levels. Thank you so much for joining me today. If you found this explainer valuable, please smash that like button, subscribe to the Noob Selling Options community, and let's keep navigating these massive market shifts together. I'll see you in the next one.